All right. Good afternoon, everyone. Welcome. We're going to give you guys just a few seconds to let some of our attendees log in. So we want to thank you for joining us today and give us just a second and we'll get started with today's webinar. Nice. Welcome, everyone. Feel free to utilize the chat to introduce yourself to other entrepreneurs on the call. Every opportunity to engage is a great one here at EMSDC. So I want to thank you again for those who may have not had the opportunity to connect with me. My name is Aaliyah Bunch. I'm the Director of Stakeholder Services here at EMSDC. And I want to thank you guys and to wish you a Happy New Year. Thank you for joining one of our first live webinars of the year. We're super excited about all of the partner opportunities and collaborations that we are hosting this year. So please check out our website so you guys are not leaving any money on the table or opportunities on the table as well. So today we'll be introducing our partners. Some of you guys may be familiar with some of our funding partners from Founders First. We're super excited about connecting with Mr. LaJean Thompson. He's going to be able to tell you a little bit more about his background and about the organization that he's representing and about the amazing resources that they're offering. So if you have any questions, feel free to tap into the Q&A feature. We'll make sure that once we get through the presentation, we will get to everyone's questions. And you can also feel free to use the chat. So once again, LaJean Thompson, they're all yours. Thank you again for joining.
Absolutely, absolutely. First and foremost, I want to say thank you to you, Aaliyah, as well as Megan, for providing this opportunity for me to engage your founders to really share with them more about who we are, who we serve, and how we can potentially become their growth capital provider, growth capital partner. And I'll speak more to that as we get into the presentation itself. Megan, and the founders, let me start by just giving a brief background about who I am. This is not about the LaJean Thompson show. This is really about Founders First, but just to level set the stage and provide some insight to who I am and how I represent this business. So I am a regional development manager for Founders First Capital Partners, and I have the entire East Coast division. Okay. A little bit about me. I am a seasoned capital connector and trusted growth partner to high-performing founders. As a regional development manager for Founders First, I help service-based B2B as well as B2G businesses access the non-dilutive growth capital they need to really scale sustainably. I have a background in finance, entrepreneurship, business development. What else can I say? I bring a sharp insight to the founder journey, right? That's really my super strength and my muscle, especially as it pertains to the capital constraint markets, right? I'm really known to for my no fluff style, my results driven approach. I've earned a reputation for closing capital, unlocking opportunity, and really accelerating growth across industries like tech, real estate, media, you name it. If you need someone who can really provide you with that solid access to capital, I am one who works very diligently on behalf of my clients and my portfolio companies. So that's just a little bit about me, okay? But this webinar is really about who are we? Who is Founders First Capital Partners, and how can we potentially support you? All right. So this webinar is going to be really centered on how do we unlock founder-friendly growth capital? Okay. How does Founders First Capital Partners help the B2B, the B2G service-based businesses to help them scale without giving up equity or control? Okay. Let's move forward. All right. So let me start with our agenda. Okay, we're going to talk about why capital access really breaks for growing businesses. Okay, we're going to talk about where Founders First fits in that conundrum. We're going to talk about how our funding works. I'm going to make it really simple. I'm not going to talk over your head. I'm not going to use jargon. This is going to, when you leave this webinar, you're going to be more informed, more educated on what are your your opportunities and your options in regards to getting access to the growth capital that is founder friendly and that can help you grow and scale exponentially very fast. Okay, we're going to discuss who do we fund. Okay, how do we fund? We're going to also talk about that journey. What does it look like getting into our pipeline from start of conversation to funds deployment? I'm going to give you a snapshot of what that looks like in real time. Okay. Now, let's talk about the founder reality. Okay. Growing businesses often they hit a wall. Okay. Revenue is coming in, but it's uneven, right? Banks want collateral and long histories. Equity capital demands ownership and control. Fast money like MCAs are very extractive, and it comes with exorbitant amount of hidden costs that really constrains your cash flow on a monthly, as well as some daily as well as monthly basis. Okay, so let's talk about why traditional capital misses the market. Okay, the capital gap is real. All right, traditional banks are really designed for those businesses that are predictable. They're well established. These companies are growth companies, but they're in a position where they're going to have to really put up significant collateral to really be attractive to growth capital, right? They need guarantees that you may not be yet ready to provide. Okay, we're not asking for you to pull up your house. We're not looking for it. We're not asset-based lending. We're not looking for you to pledge any significant capital, any significant collateral for any of our funding. That's totally different with banks. Okay. Now let's talk about the VCs. We know VCs. We all seen Shark Tank. They're chasing the next unicorn, the next Facebook. Okay. Venture capital targets high risk, high reward tech companies that are really seeking that billion dollar, multi-billion dollar exit. Okay. Most of our service-based companies are operating well below that threshold. Even though they're building sustainable businesses, they're not attractive to VCs. Okay. Then there's the MCAs, and we get this a lot. We get a lot of our portfolio companies that are coming to us asking for support to help them get rid of this extractive debt that's currently suffocating their cash flow on a monthly basis, right? So MCAs, they provide that instant relief, but they charge APRs anywhere from 40 to 200%, right? That's usury, that should be punitive, but it is what it is. They often require daily as well as weekly draws. Okay, so that's a lot of the traditional funding gaps that we see just from dealing with our portfolio companies. They're not ready. They don't want to give up equity or control, so they're not tech or SaaS businesses, so they're not attracted to the VCs. They're the banks. The banks they want the heavy collateral that they're not willing to provide or quite simply don't have to provide. And then MCAs are just going to kill your cash flow on a monthly basis. Okay. So let's talk about, where do we fit in? You may have heard this product called revenue-based financing. That's one of our flagship products. This is it fits a lot of the models that demonstrate that they have the predictable recurring revenue. It allows founders to pay lower amounts for months where their revenue is slow, and it allows them to accelerate their payments with months are explosive, and the revenue is really explosive for that particular month, right? So when you look at what's available, we already discussed banks. They want to have heavy collateral. MCAs very fast but very costly. Angels, often cannot provide that capital to really help scale small to mid-sized businesses. And then, CPG companies, of course, they have crowdfunding opportunities or options. And then VCs are really looking for that unicorn that's, going to be the next, Instagram, Facebook, etc. Revenue-based financing, we actually, we're one of the leading lenders in this space. Revenue-based RBF is really going to provide businesses with both the fast as well as the non-dilutive capital at a moderate cost. Okay, and we're going to talk more about not just revenue-based financing. We're going to talk about our term loan option, and we're going to talk about our hybrid loan option as well. Okay, so where do we fit in? We fund the overlooked middle. Okay, so we don't need years of perfect financials, right? We do need clean financials, but we're only looking for the last 24 months, okay? So we don't need 3 to 5 years of financials. We don't need any collateral, okay? All of our lending solutions, we do not ask for any collateral to secure any of those opportunities, okay? And we will evaluate the business based on its current revenue and growth trajectory, okay? So we are beyond the bank in regards to that. Before you think about venture capital, if you are one of those companies that you're looking for some, equity investors to come in, we're not looking for that $1 billion exit, right? We partner with profitable service-based businesses that are building sustainably, and they're and they're growing and scaling exponentially. Okay. Then is that real then it's the our revenue based model is really flexible. And again, I'm going to do a deep dive into what that looks like. It's not rigid. We're looking at monthly payments based on the strength of your monthly revenues. We're not looking at pitch decks. We're not looking at projections, pro formas, etc. Right? In order for us to make our decision. All right. So founders first, we really sit in that critical gap between traditional debt and institutional equity. All right. We will provide growth capital that it is best, for your business. It's not a one size fits all. Okay. We look at each individual opportunity as its own unique opportunity. So it's not a one size fits all. Okay. Now let's kind of go into a little bit about who we are, right? I want to make sure that you understand exactly who Founders First is, what we do, what is our genesis, what is our purpose, our mission. So we were established to really advance an inclusive economy by making growth capital possible for all, right? It doesn't matter your your geography, your background. We are going to remain firmly committed to making sure that we are serving those underserved businesses, regardless of the geopolitical environment that we're currently in. Our mission is not going to change. We're going to stay focused on those underserved business owners and those that are often overlooked when it comes to getting access to capital, right? So how do we do it? We drive economic mobility by providing the innovative growth capital and wraparound support services to really help you as the founder accelerate your service-based business to get you to that mid-market level, okay? Why do we do it? Founders First, we've been around since 2015. This is the brainchild of our CEO. This is her seventh business venture. She had 3 successful exits of her tech companies, and she was able to raise $30 million of private equity for her various business ventures. And with Founders First Capital Partners, she's been able to raise over $200 million for us to really deploy to underserved, underrepresented founders. We do it because we believe that we really want to make sure that we're advancing, our founders have the opportunity to get access to the capital so they can hire net new employees, right? So they're advancing quality jobs. There's wealth creation, right? And that's, across, these various communities that we serve, in the United States, right? So that's why we do what we do. Who do we serve? So we serve those growing, underinvested, service-based B2B, B2G companies who have the potential to grow from 500K in annual recurring revenue to hit that mid-market level where they're revenuing between $10 million to $50 million. And that's within, we're looking at annual revenue, right? So that's the goal. That's what we want. We want to take our portfolio companies that are currently in that range between 500K and $10 million in annual revenue, and we want to help them grow to the mid-market so their revenues grow north to $10 million and above. So that's why that's why we do what we do. That's who we serve. That's how we serve. And you have a little bit of the genesis behind how we came into existence. All right. Our results will always tell our story. So when you look at our portfolio companies, we've been able to touch over 4,000 businesses and founders since 2015. Of those cluster cohort founders, 75% plus have been able to increase their revenues by leveraging our capital correctly. Okay. Over 60% have been able to increase their profits, add recurring revenue to their pipeline. 57% and above have been able to add net new employees to their pipeline, whether that's sales, whether that's marketing, whether it's any aspect of operations to help you grow and scale. And over 50% have received external funding, right? We're talking about north of $79 million secured in external funding. Over close to 1,000 these are premium wage jobs, over 1,000 premium wage jobs created. All right. So that's what we're impact lenders. We're not just deploying capital. With us, it's relationship driven. So the lifetime value with our portfolio companies is anywhere between 3 to 5 years. They continually come back to us for advisory support services. They continually come back to us for additional follow-on funding. And it's based because we're not transactional, right? We're relational. That's how we drive our business. It's the relationship is the real currency that really matters. All right. So who do we serve? So our ideal customer profile is that small service-based B2B, B2G company. They've been in business for a minimum of 2 years. Their revenue is anywhere between $500K to $10 million. They're profitable or on a pathway to profitability, right? So we'll be able to ascertain by looking at a set of financials. If a company is not currently profitable, we can do the analysis and we can say, okay, based upon the projections and historicals, we see that they have the propensity or the ability to be profitable in this particular quarter of this particular fiscal year, et cetera, right? And they're also asset light. Okay, our companies are asset light. Again, we do not to secure, you do not have to secure any of our lending solutions with collateral. Not only are we non-dilutive, but we do not require any collateral. Okay, what do we fund? We fund expansion. Okay, so if you're looking for verticals, if you're looking for opportunities, right now the biggest way to really scale a business is really through M&A, right? Really acquiring new businesses that are cash flowing and profitable, right? We also fund hiring and talent development. Okay, if you're looking for some net new employees to add to your pipeline, our capital leverage correctly can help you do that. If there's any tech upgrades or any infrastructure build out, germane or relevant to your business model, that's going to help you either go from project based to really recurring revenue, right? Or just really scaling your revenue north. Whatever that build out looks like, we can support that with our funding. Operational scale up, okay? And most importantly, I would say probably 80% of my portfolio companies are looking for us to help them with that extractive MCA debt that they gotten themselves into, right? So we're able to refinance extracted debt, get that off your debt schedule. That's going to relieve you from a cash flow perspective on a monthly basis. Some of our companies, we're helping them save $70,000 a month in just an MCA debt that what can you do as a founder if you had an additional 40, 50, 60, $70,000 a month? Think about the talent that you can hire. Think about how you can ideate. Think about how you can leverage technology, AI, et cetera. If we're able to relieve a lot of those cash flow constraints, and that on a monthly basis, you have more money that you can just funnel into the business for growth. Okay. Let me park here for a minute because it's very important. I want you to really understand who we are not. Okay, we're not merchant cash advance. None of our products you'll see 40 to 200% interest rates. This is not expensive. Our capital is flexible, right? If we did a comparison, to a traditional bank or the SBA, our capital is going to be slightly higher, and it's because we don't require any collateral. Okay, you do not have to put up any collateral, nor are you, it's non-dilutive. You're not giving up any equity or control of the business, okay? But we are not MCA or anything predatory, anything usury in nature, okay? There are no, it's non-dilutive, so we're not looking at board seats. We're not talking about ownership. You're going to always maintain 100% of ownership with your business. Okay. With us, we do our amortization on a monthly basis. Okay. There's no daily draws. There's no weekly draws. Okay. And as far as asset seizures, we're not an asset seizure model. Okay. You're going to hear this as a repetitive theme. We are non-collateral, non-dilutive. We will never, ever, ask any of our portfolio companies to put up any collateral for any of our lending solutions. So you're probably asking, well, how do we hedge ourselves from risk, right? So we have a very, very diligent process of really analyzing analyzing credits to see where the alignment is, where the pathway forward is. We're impact lenders, so we don't want to create any additional burden to you as a business owner, right? So we're looking at debt service coverage ratio. What can you afford? Can you afford to take on our debt? Number one, right? Because again, our debt leveraged correctly is really designed to help you grow and scale. Okay, so we hedge ourselves from for the fact that we're not securing any of these products, we hedge ourselves by doing all of that legwork up front, doing a very thorough analysis of a set of financials to assess, is there a pathway forward? Do you have the ability to take on this type of debt? And that's how we hedge our risk. Okay. Doesn't mean that, we're going to, our impairment rate is going to be zero. Doesn't mean that, right? But we do our level best to make sure that, any opportunity that is presented to us is thoroughly vetted, because again, there is no collateral and it's non-dilutive debt. All right. So how do we compare? All right. We know banks are slow, very collateral heavy. Okay. VCs, they want ownership, they want control. Okay. And a lot of other negative covenant restrictions come with that as well. MCA, we know it's fast, but it's very expensive, very extractive debt. Okay. As far as Founders First, we're flexible. Okay, we're aligned and we're non-dilutive. Okay, so it's no one size fits all. We're going to look at every credit as its individual credit. We're going to do a thorough analysis of a set of financials to assess whether or not there's a pathway forward. And then if there is a pathway forward, we're making sure that we're presenting an offer that is fully aligned with the business needs. Okay, so that's our biggest differentiator in this space. Non-dilutive growth capital, never have to put up any collateral. We're going to look at every credit as an individual on an individual basis. And if there is a pathway forward, we're going to design and structure the facility so that it is the best match for your business in regards to how you grow and scale moving forward. All right. So how does our capital work? We really built this around how your revenue is actually coming in. Okay. We look at the real performance of the business. Okay. We take into consideration projections, but we're looking at historicals and we're looking at, contracts in hand, etc. Okay. We fund against real performance. Payments will always be aligned with your cash flow. Again, we are impact lenders. We're not looking to stifle or constrain any cash flow, right? So it's going to always be aligned with your payments will always be aligned with your cash flow. And we're going to always think growth, right? Our capital, yes, you can leverage our capital for some for operating costs, but it's really about our capital is growth capital. Okay. And then you're going to always retain your ownership, never dilute that. You're going to always be in the driver's seat. We're just partnering with you. This is a shared success model. Okay. So as your company is growing and scaling, we want to be that growth capital provider that you connect with, so that anytime you need an injection or additional tranche of funding, we will be that growth capital provider that could potentially provide that source for you, that resource for you. So again, the goal is to keep scaling, hitting those demonstratable milestones so that you can hit that mid-market level. Let's talk about some of our funding structures. So I started talking a little bit about revenue-based financing. That's one of our flagship products. Revenue-based financing is really designed to help you optimize and maximize your cash flow on a monthly basis. Okay, payments will always be aligned with your cash flow. So we're going to look at the strength of your monthly cash receipts to determine what is your payment for that particular month. Okay, so let's say you have let's say there's some seasonality to your business. Let's say you have some slow months. Okay, for that particular month, we're going to look at your cash receipts and say, hey, you had a slow month, so you're going to pay a lower amount for this particular month. Just on the flip side of that, okay, as the revenue grows and accelerates, it's going to also accelerate your payment. So if you have an explosive month in revenue, you'll find that your payment for that particular month will be a little higher, slightly higher as well. Okay, that's revenue-based financing. It's really designed to make sure that we're mitigating and removing a lot of those cash flow constraints that you find with other loan structures. Okay, revenue-based financing is designed for those companies that demonstrate that a significant portion of their revenue, whether it's 80, 90, 100% of their revenue, is coming from recurring enterprise clients. Okay, so revenue-based financing is really about, if you have that predictable recurring revenue model, this could potentially be the best fit for you out of our lending solutions. We have a traditional term loan. The term loan, it's a fixed product, just like all of the term loans. To qualify for our term loan, we got to see that the business is profitable. Okay, if the business is profitable and from a debt service coverage ratio perspective can take on our debt, we may offer you a term loan. This is for founders that are looking for that fixed structured payment model. Again, revenue-based financing is variable. It's going to fluctuate based off your monthly cash receipts. Our term loan is designed that you know exactly what your monthly payment will be for the duration of the loan. Okay. It's predictable. Now we do have a hybrid product. This is a product where it's customized, right? It's a blend of the fixed as well, the fixed loan as well as the revenue-based financing loan. It's really designed to give you flexibility. Okay. So once we do an assessment of a set of financials, our investment team very diligent in their process and how they identify what is the best solution for that particular business, may decide that the hybrid loan, which will give you the best of both worlds, right? It give you the elements of the revenue-based financing structure as well as the term loan structure. Okay, so here these are our three lending solutions: revenue-based financing, term loan, as well as our hybrid loan. Okay. Let me go a little deeper into helping really kind of convey exactly, what is the strength and the benefit, because everything has to be a benefit to you as a founder of being eligible to qualify for our revenue-based financing product. Okay, so we lend up to $2 million. We do it in tranches. The cap for our initial tranche is $750,000, but we can potentially take any of our businesses up to $2 million in growth capital. And what we typically do is we look anywhere, it's a sliding scale, it can be anywhere between 10 to 30% of your trailing 12-month revenue. We use that as the benchmark to say, okay, this is what you can potentially qualify for. Now, with our revenue-based financing, it's important to note that there is no set interest rate, okay, or monthly payment or maturity, okay? It's really designed to, again, help you relieve those cash flow constraints and to really help you maximize your cash flow on a monthly basis, okay? As far as subordination, if there's, as far as the capital stack is concerned, we can come behind SBA as well as CDFIs. Other debt, less favorable debt, we'll probably consolidate and take that off your debt schedule. But we can absolutely subordinate to any SBA as well as CDFI loans that you currently have. All right. I'm going to give you an example of what a revenue-based financing structure facility can look like. Okay. So let's say the annual revenue, your annual revenue is $1 million. Okay. You're coming to us seeking an amount of $200,000. The maturity, let's say this is a loan for 3-year maturity loan. The payment, we do this, we call it royalty. Okay. So the royalty can be anywhere between 2 to 9%. Okay. In this case, the royalty would be between 2 to 5%. Okay. Because again, remember, slower months, you're going to pay less. Higher months, you're going to pay more. Okay. So in this particular example, if you were to borrow $200,000 as far as the repayment, we're looking at capturing 1.3x of the principal. Okay. So at $1 million, borrowing $200,000 at a 3-year maturity, the payment, we're looking at a 2 to 5% royalty per month. Okay. That's going to be tied to the strength of your monthly cash receipts. All in, you would be at $260,000. That represents 1.3x of the principal. That's how a revenue-based financing facility can be structured. Okay. Again, the term loan is fixed. You know exactly what that looks like. You know exactly what you're going to pay on a monthly basis. Revenue-based financing, again, is going to fluctuate. No set interest rate, no set monthly payment, and no set maturity. Okay. Again, revenue-based finance is for those companies that can demonstrate that they have recurring and predictable revenue in their business model. All right. So let's talk about the growing need for growth capital for scaling businesses. Who do we look for? Here's a snapshot. Okay. We want the business that has to, it has to be seasoned at least 2 years or more. Okay. You have to have clean, consistent financials. Okay. Even though we're targeting underrepresented, underserved businesses, we absolutely, it is a must that, in order for us to underwrite any opportunity, that you have to have consistent and clean financials. Okay. It has to be clear where your revenue concentration is. Okay. We're looking at your clear growth narrative. What are your strategies moving forward to grow and scale the business? Okay. So that's a snapshot. That's what we're looking for. Okay. Outside of the fact that we know that you're a service-based B2B, B2G, you've been in business for 2 years, right? We need to know what is the growth strategy moving forward? How do you plan to grow and scale the business? Okay. When we do our underwriting assessment, we're looking at, we're looking at a lot of metrics. We're looking at your gross profit margin. We're looking at your net income. We're looking at your runway. We're looking at your customer concentration. We're looking at your year-over-year growth. So we're looking at a lot of metrics to assess, are you the right fit? Are we the right fit, et cetera. Okay. Let's talk about the funding journey. What does this look like? Okay, from start of conversation to funds deployment. What does this look like? Okay, if you went to the bank, SBA, you can take 3 to 6 months just to get it, think that this is going to actually get to the finish line, just to be told, no, underwriting found a flag, so we can't move forward. With us, from start of conversation to funds deployment, we typically do this within a 30 to 45-day window. So that's the initial conversation, the discovery call, that's getting access to a set of clean financials, that's doing the assessment and analysis of the financials, that's presenting, potentially presenting an opportunity, offer to our investment committee for their approval, for us to issue a term sheet. That's term sheet dissemination. That's getting term sheet signed. That's really helping, giving us that's the kicker and the trigger to activate due diligence. That's doing everything. So I want to just share with you that this is not, we don't skip on any of this stuff. Okay, from start of conversation to funds deployment, we do this within a 30 to 45-day window, as long as the founder is being very engaged and very responsive to any need, whether it's need of information, need of documentation, etc. If you're being responsive and very and turning things around that the underwriters may need expeditiously, we can absolutely do this within a 30 to 45-day window. Right? Now, we talked a little bit about the snapshot, but I want to really do a deeper dive into what are the financials that we need. Okay, we look at the last trailing 24 months. All right, so we don't need 3 to 5 years of financials. Okay, we're looking at the last trailing 24 months. We're looking at your P&L. So we're looking at your income statement, your balance sheet, your cash flow statement. We're looking at your revenue by customer, as well as a debt schedule. Now, with your financials, we need to see that broken down monthly. So, in order for things to move very fluidly, when we get a set of financials, we're very clear with our founders. Please don't send annual totals, don't send quarterly totals. We need everything broken down monthly, and we need it in an Excel file. Okay. Once we get a set of financials and we do an assessment, we can tell our founders within 24 to 48 hours if there is a pathway forward. Okay, that's best case scenario. Now, let's say the underwriters found some red flags, then we will, if it's not a deal killer, then we'll continually engage with the founder to get, any explanation around, if it's an issue with financials. We want to make sure that we're not leaving anything on the table. So we'll do a deeper dive to find out and ascertain exactly what happened, whether it's something that took place a particular month that was a red flag. We'd rather get that information directly from the founder. So let's say best case scenario, everything works out. Then we're able to really kick this into where we can present an offer to a proposal to our investment committee, giving us permission to provide a term sheet to the founder. Okay, so let's say worst case scenario, 24 to 48 hours later, I have to have that conversation with my client, say, hey, listen, this is what the underwriters found. Okay, it's not a no, but not right now, and here's why. So what we do is we provide feedback, relevant, tangible, practical feedback that can help you be, steps you can take to help you be, more fundable, whether it's with Founders First Capital Partners or any other lender that you may explore moving forward. Okay, so we never leave it as a cold no. We never say, unfortunately, we can't move forward. We're going to let you know why. Then we're going to give you some bullet point, step-by-step action, steps that you can take to really turn things around. And then maybe we have to revisit the opportunity a quarter or two down the road, right? But at least the relationship is established. At least we know exactly, what type of business this business is. We have a sense of the founder, et cetera, right? Because capital deployment is really about relationships, guys. All right. Anybody with access to capital can deploy capital. But the real currency, the real value proposition is how we maintain, cultivate, and foster our relationships with our portfolio founders. Okay. So Again, from initial conversation to funding, we're able to do this within a 30 to 45-day window. Okay. We also, for our founders to really expedite this process, instead of you sending everything over to us manually, if you're using an online accounting software such as QuickBooks Online, we're able to pull this information directly via a Kodak sync. Okay, and that's industry. But when I speak to my founders, I make sure that I thoroughly educate them on what is Kodak, right? I teach, I send them documentation so they understand the process, what it is, how secure and encrypted this process is. And I also show them, I share with them a tutorial on how do you really export these monthly financials so we have it in the right format so that we can expedite our assessment analysis so that, in lending, time can kill a deal. Okay, so we move fast without skipping any of the quality assurance steps to make sure that we're moving with the goal of getting an opportunity to a potential facility. Okay. What does success look like? I told you we're relational. We're not, this is not transactional. So we're here for the long ride, right? This is a shared success model. Okay. So the success really looks like us being your long-term capital partner. Okay. And that's providing advisory support services in addition to providing deploying capital. Okay. Your capital grows, we grow with you. Again, you'll never have to give up any equity or control of the business. You never have to pledge any collateral, etc. Okay. There is room, we call it tranches, okay? So there is room to return for future rounds. So that's what we really want, okay? We can take a business up to $2 million, okay? So the goal is that we have someone in our pipeline and we've deployed an initial tranche. We want to grow it with that business. As they grow, we want to grow with them, okay? I'll give you an example. That one of my portfolio companies came to me, initial tranche was 500K, okay? I would say probably 3 quarters later, they came seeking an additional tranche, and we were successful in getting them follow-on funding. Okay, so we really pride ourselves on being that capital partner where it's not a one and done. Okay, we want you to continually come back to us. Okay, for that follow-on funding. All right, so. I know I had a short amount of time to really just kind of introduce who we are, and I really wanted to make sure this was very simple. I wanted to make sure that it was easily digestible, and you walk away from this webinar with a better understanding of who Founders First Capital Partners is. How do we deploy capital? Who do we partner with in regards to founders, businesses, etc.? And what does the journey look like, right? What is the process from startup conversations to funds deployment? Okay, so listen, if you're ready. Okay, if you're ready to start a conversation, okay, I really encourage you to reach out to me. Here's my contact information. I'm going to make sure Megan disseminates my information to everyone who is on this webinar. Okay, have a 15 to 30-minute conversation with me. Okay, let's start the relationship. Let's start to cultivate. Let me understand your business model. Let me understand your friction points and how we can provide a solution to some of those pain points. Let me understand your growth strategy, okay? So we can provide some solutions that can really support and help you fuel and activate those growth strategies, all right? So we want to be your long-term non-dilutive growth capital partner for businesses that, again, you already have the traction, okay? You've already, you're not in that startup phase, right? You have significant traction in your prospective industry. Now you're looking to grow and scale. Those activities are usually germane or tied to some dollar amount. We want to be that growth capital partner for you so that we can share in your success as you grow and scale, right? To reach me, you can do so via 267-894-8780. You may also do so via email. It's my first initial last name, L. Thompson, at F as in Frank, 1, S as in Sam, T as in Tom, C as in capital, P as in partner.com. I'm very responsive. Let's get a calendar. Let's get a meeting on the calendar. Again, 15-minute conversation, 30-minute conversation. It'll be very exploratory in nature. I am not selling anything. Okay. I want you to see me as a resource and not a salesperson, because that's not what I am. Okay. We are solution providers. We are resource providers. Okay. We are growth capital providers. With that being said, Leah, I'll pass it back to you. And I hope there are some rich and engaging comments or questions that everyone has. And it'll be my humble pleasure to answer those questions.
Woo. I don't know, LeJohn. I don't know if they have any questions after that high level overview. I'm captivated. Really appreciate your time. And I didn't get a chance to tell you guys in the beginning that this is a recorded webinar. So we will be sharing the recording on our website if you didn't have the opportunity to take some notes. So now that you guys done dug in, you learned about Founders First, the criterias and the requirements. I appreciate you mentioning that this is not a transactional relationship. These growth partners are looking to fuel your funding throughout your growth. So let's find some solutions. I mean, it seems like these folks has figured out every barrier, and helped you figure out how to not only borrow money but also how to repay it while you're growing your business. So I'm gonna check out the Q&A to see if there's any questions. And I don't see any, but don't be shy. And as LeJean said, you guys have his contact information, so you'll be able to connect with him one-on-one, because we know it's not like a one-size-all solution for these type of conversations. But I do thank you for joining again, and I'm going to give everyone a few more minutes.
You're on mute, Leah.
I went on mute. Just to make sure that, like I said, LeJean went over a lot of details. So you guys may not have a lot of questions. So therefore, if you wanted to receive this information or the recorded information, feel free to follow up with Meg directly, but she will more than likely send out LeJean's information in the recording after the call is over. So thanks again. Just a few other things I want to make sure you guys take advantage of. We have the Super Matchmaker coming up on the 28th. So please make sure, if you did not have the opportunity to sign up and see which buyers are on here with some of the upcoming opportunities for 2026, please tap into Meg to make sure that your profile is seen by our partners. Um, but back to funded. Thank you again, LeJean. LeJean is from the New Jersey area. He didn't mention, but these guys are throughout the region. We will be hosting more webinars to talk about any other resources or tools that they are offering from Founders First. So you guys make sure that you tap in and stay up to breath with what they're offering at Founders First. So I'm just going to check the Q&A one more time before I let you guys go. And LeJean, I want to thank you guys again, and you and your amazing partners across the region. And I want to thank you all for joining us today. Please check out our website and our social medias for upcoming opportunities to engage with our amazing partners across the region. Thank you again, guys, and you have an amazing day.
Take care, everybody. Talk
Bye-bye.
soon.